Welcome back, Junkies. It's Brandon Dukeman here with Will Harvey. Thanks for joining us today for another daily episode, and it's Multifamily Monday, so we are excited to get started. But first, if you're enjoying all these Multifamily Mondays or all these other episodes, refer a friend to the Wealth Junkies so that we can grow and reach out to as many people as we can. And with that, I'm going to turn it over to Will to introduce our guest for the day.
Thanks, Brandon. Today on the show, we have Paul Moore. So Paul started out in corporate America. He then became an entrepreneur, built and sold a very successful company at a young age, and then he transitioned into multifamily. And I skipped over a lot of stuff. There was definitely some bumps and bruises along the way.
Oh, yeah.
But he's also written a book, and it was instrumental to me in getting started in multifamily. And I definitely had some bumps and bruises from the single family world, and it got me to kind of that aha light bulb moment. The book is called The Perfect Investment, and we're really excited to talk about Paul's journey. So Paul, thanks so much for coming on our show. Can you just give the listeners a little bit more about your background and what got you to where you are today?
Yeah, thanks for having me on, guys.
Sure.
I liked Ford Motor Company. You know, this was like 30 years ago, and but I always sensed I was supposed to do something different. I didn't know any entrepreneurs growing up except the local pharmacist, and that looked boring. So but I finally was able to break away from Ford, started a company, and after selling that, I found myself in my early to mid 30s as a type A driven entrepreneur. And I tried to start a nonprofit organization. It was actually sort of a ministry to international students coming to the US. And the people that were volunteering with me wanted to do like 2 or 3 retreats a year. And I wanted to do one like every weekend, you know.
Because
So
you're
it
basically
was like,
retired, right?
yeah. So kind of like that. And so I'll tell you, retirement, if you want to call it semi-retirement, was miserable for me. And I actually don't recommend it for any type A driven person. Actually, I don't even recommend it for anybody, but that's another story. Anyway, I heard that you could buy houses, we call them fixer uppers, and on the courthouse steps. And so at a cheap price. So my buddy and I went down and we got a house for like half of its value on the courthouse steps. And we were hooked into real estate. That was before flipping the term ever came out. And of course, HGTV and all the other shows out there, you know, have made flipping a big thing. And
right.
But I tell you,
It's as easy as they make it look, right?
Oh, you know it is.
Yeah, that's what I thought.
But anyway, so seriously, the whole market has just become, you know, overcrowded. So many people competing for every deal. And so over the years, I transitioned from flipping houses to building ground up. I did a subdivision. I started flipping high-end waterfront lots at a resort called Smith Mountain Lake in Virginia.
Oh, yeah.
Beautiful lake, by the way.
Yeah, it's amazing. And I still actually have a website. I operate passively there. I spend about an hour a month on it and generate quite a few realtor leads that I sell. But at any rate, I eventually discovered commercial real estate. And you know, guys, I didn't even understand what I had tapped into till years later. But when I did, like you, I was blown away at the difference between commercial and, you know, including commercial multifamily versus residential. So that's kind of a quick history.
Yeah, there's a lot to unpack there. Let me rewind. I want to get into all the real estate stuff, talk about the bumps and bruises, but what was the company that you started? What was the industry that you were in?
Detroit? Yeah, I actually joined a partner and we started a staffing company. We provided outsourced payroll, taxes, benefits, workers' comp, unemployment insurance to companies from 2 or 3 employees up to say 100. It's called a PEO, professional employer organization, and they're still around today.
And what made you start that, and how did you come up with the capital to do that?
Yeah, it was more or less sweat equity, thankfully. And so my business partner had also been in my MBA program, had also worked at Ford. He got bored much sooner than I did. He was out in 13 months after having a phenomenal job there. And he
just hated the hamster on the wheel thing.
Yeah, we just couldn't see ourselves doing this for 30 or 40 years. And now that I look back, can't imagine what that would have been like compared to the life
Yeah.
I've had. I mean, we've had a lot more uncertainty, a lot more insecurity, a lot more credit cards run up to the max, and not knowing where we're going to get money for our next mortgage payment. Other than that, though, it's been great.
Yeah, right.
Yeah, just those little headaches. Yeah.
Yeah.
Yeah, it's that whole thing where what do they say? I'd rather work 100 hours for myself than 40 hours for someone else. You know?
Yeah. Right. Right.
Yeah. No, that's
So
that's that's good.
so Paul, what attracted you to real estate in the first place?
Well, I mean, I could give all kinds of glorified answers, but the truth is this. I had a friend who just moved here from Charlotte, and he was bored. He had nothing to do. He was looking for a job or something to do. And so we just heard that we could do this. And so we just went and tried it.
And tell us about kind of the first fix and flip that you guys purchased.
It's a great story, actually. We went to the courthouse steps in Martinsville, Virginia. Guys,
Mhm.
I kid you not, the unemployment rate was 22%. But
Wow.
we
Wow.
ignored that, of course. And we went to the courthouse steps, and we intentionally did not bring any money at all because we knew you needed 10% down to buy anything. And we committed to each other. We were not going to buy a house today. We were just going to watch all the
Uh-oh.
bidders and
It's like
how it
going to the
worked.
pet store and saying, "I'm never going to
Right.
buy this dog," and you
Exactly.
walk out with a dog.
Well, it turned out to be an icy day, December 20th of 2000. And so there was snow and ice. And so we still made the trip anyway. We were the only people there, though. Well, on the way there, we stopped by the house, which was empty, and it looked like it was in perfect shape. It was a perfect, nice brick ranch in an okay average neighborhood. And we did a little calculation. We thought this thing's worth 65,000 or so. Now we hadn't taken into account the unemployment rate in the situation there, but anyway. Anyway, we went to the courthouse steps. We were the only people there, and she opens the bidding at 34. I think it was 32 or $34,000. And we looked at each other and we're like, oh my goodness, we were so stupid not to bring a cashier's check. So we said, hey, it's lunchtime. Would you like to go to lunch and then come back and meet us here in 40 minutes? Because we needed that much time to get to our bank and back. And she agreed. I couldn't believe it. So we bought the house for either 32 or 34,000. All we did is like paint one room, clean it up, and we stuck a FSBO sign in the yard a few weeks later. Well, it just so happened on the Monday morning when we put the FSBO for sale by owner sign in the yard at 10 a.m., somebody was driving by on this dead end street going back to Washington, D.C., and they were looking for a house on that street. So we got a call 2 hours later, and they paid us $65,000, the full asking price, with no hassles. And we
No
thought,
kidding.
this is easy. We
Yeah.
can do one
They're
of
all
these
going
a
to be like
week.
this. Yeah.
Yeah, you know it.
The Midas
So
touch, right? You guys have the Midas touch.
yeah. So we lost money on 2 of the next 4 deals. But
How
anyway,
much money?
not too much. I think we lost 5,000 on
Okay.
one and maybe 8 on the other. But anyway, we were throttled in our enthusiasm after that. But we did have a lot of fun. We did like over 60 houses, I think.
Okay.
That's awesome.
And then what led you into the spec home game, that whole world?
Well, I thought if we, can make 25,000 or whatever doing this, we should be able to make a lot more from ground up. So there was a lot of modular home factories around our area in Southwest Virginia. And so, and this is like a nicer than a double wide. It's basically a stick built home that's pre-built in a factory. So we thought, well, we can get one of these stick built homes and, for like, say $70,000, put it on a $25,000 lot and sell it for like 200. Well, it wasn't that easy, of course. But anyway, my buddy who's always looking at what's the simplest path to wealth. He's like, nope, that's not the simplest path for me. You're on your own. And so I did it on my own, and I did okay until I finally jumped up to a true stick built ground up construction. Then I really flopped and said, I don't want to do this again.
How did it flop?
Well, it was on Smith Mountain Lake in Virginia. It was in the boom years of around 2004.
Okay.
And, we should have made $100,000 profit on it based on our budget. And we ended up, for a whole bunch of horrifying reasons, we ended up losing $40,000
Oh man.
instead. And I said, I'm not cut out. I mean, a guy who doesn't know how to tighten the doorknob on his bedroom shouldn't be building a house from the ground up.
Yep. You
That
sound
is
like me.
very funny.
Yeah.
Yeah.
Well, so what are some of the what are some of the reasons it ended up as as a disaster?
Yeah, terrible contractors. One contractor actually, he said he knew how to do drywall. I mean, he said he did, and he said he knew how to do tile, and
Yeah,
he
so do
can,
I. So what?
yeah, 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 and he convinced me to actually buy him a track hoe, which is a sort of a bulldozer, to actually grade the backyard because he said he couldn't find anyone to rent him one
Yeah,
anywhere. So he
they're
convinced me
expensive.
to buy one, and ended up he actually kept it. He actually stole it from me, and
Wow.
get this, I kid you not, we sold the house for 500,000. People moved in, and it was a lot of drywall. We're talking, 20-foot vaulted ceilings and all that. It was really nice. And my painter, after he had painted it, got in. No, not my painter. Another guy came in and he said, "Hey, I was just looking at your walls and I ran a bright light." Now, these people had already bought it and moved in. He was going back to tweak the plumbing. And he said, I got to looking at your walls. They're all wavy. Your drywall guy did not know what he was doing, and your painter just painted over it.
Oh,
And so I
Oh,
called the owner and I said, I am so sorry to tell you this. I know you've got all your furniture in there and you're moving in this week. I'm going to have to cover all your furniture and redo all the drywall in the house and repaint it.
wow.
And
wow.
so
That says a lot
that
about your character that you went back after the fact and
I
righted
just
what was
couldn't live
wrong.
with myself if I hadn't. And I'm glad I did. But and that guy went ahead. He not only did he do the drywall wrong, he stole the bulldozer. And anyway, so
Did you ever
not
get it back?
no,
No
but I
way.
didn't pay him for the drywall and paint and some other things either. So it sort of evened out. If
Right.
he'd done the job right, it would have been even.
That is
But
unbelievable. So that was
yeah.
your taste of that, and you said no more.
I did, and I think there's a little lesson here, and that is this. I was on a podcast with dentists this morning, and I talked to dentists, doctors, IT professionals all the time who watch HGTV, and they're like, "Hey, I want to flip some houses on the side." Guys, I'm telling you, this is not a game to get into part-time. It is not something you want to wade into. If you're making 100, 200, $500,000 a year from your day job, stick with that. Partner with somebody else to do the heavy lifting on if you want to get into the wonderful benefits of real estate.
Yeah, I totally agree. You have to be so systematized to do it, or else it's just a complete mess.
Yeah.
You're babysitting contractors, and it's just not fun. I flipped one house, and it was, no more, no mas.
Yeah, I hear you.
Yeah.
So, Paul, tell us about that kind of aha moment when you discovered multifamily real estate and commercial real estate.
Yeah. So we were in the middle of the recession, and I actually took a couple of years off to study marketing copywriting, and I was funded by that passive website I mentioned at Smith Mountain Lake in Virginia that generates leads. We were still generating leads all through the recession, and I did actually really
Wow.
well. But I took a couple of years off to do marketing copywriting, and my friend, who's also was in real estate, built he had built a couple commercial buildings. I helped him fund one of those. And he said, "Hey, there's this Bakken oil boom in North Dakota. Why don't we go up there and build housing for the oil boom?" And so we
Mm,
did. And we just had tremendous success. For time's sake, I won't give you the details, but we had a wonderful time there. And I came back, and I actually was about to buy a 6-unit apartment in my town. And I discovered this mentoring program out of Richmond, Virginia, for multifamily. And I went and met with the CEO, and I got hooked. And once I got in the program, it was even better than he advertised. It wasn't cheap, but it was better than advertised. And I so enjoyed the program. And I finally learned the value formula in commercial real estate. Guys, if you're flipping residential, or if you're doing residential real estate, you got a $300,000 house and you add $500,000 in upgrades. You finish the attic and the basement, you put in gold plated fixtures and add additions. Um, you're not going to get 800,000 out of it if the neighborhood's $300,000 homes. But in commercial real estate, it's entirely different. There's a value formula, which, as you know, it's the value equals the net operating income divided by the rate of return, or the cap rate. And once I really understood that, I was completely hooked. And here's an admission. I've never shared this with anybody, I don't think. But since you read my book in 2017, I went back and read chapter 8. I don't think I really understood the value formula when I wrote about it. I think I was just regurgitating what I'd heard. The power of it really dawned on me later, and it is really powerful. And it's the reason I would never do anything else.
It's amazing because, you know, a $50 increase, if you upgrade something and you get a $50 rent bump on a 200 unit complex. I'm not going to do the math or anything like that, but it can translate to millions of dollars in
It's
value.
amazing. It's
Yeah,
true.
it really
It's
is.
true. And I've got lots of examples of that. And we've really enjoyed that. So that's, I think, guys, this is why the Forbes 400 wealthiest people in the world invest in commercial real estate.
Mhm.
Very true.
So
Yeah.
do you focus on multifamily only, or do you venture out into other asset classes?
Well, since this is Multifamily Monday, I'll probably focus on that. But I will tell you that I've been having a really hard time. As a guy in my 50s, I really don't like overpaying. I don't like risking too much.
Right.
And I found that the deals we were able to find, we were less successful than people like Michael Blanc, Joe Fairless, and others who have found a lot of great deals. We didn't have the pipeline. And so we were finding deals that we were either overbid. I mean,
Mhm.
either we were outbid on it, or people were overbidding, I thought. And so we finally expanded from multifamily only to add self-storage and mobile
Okay.
home parks. So we invest in all three now.
Nice. Okay. And you're seeing in those you can get it's a little bit less competitive what you're looking at.
It's crazy, guys. There are 54,000 self-storage facilities in the US. That's about the same as McDonald's, Starbucks, and Subways combined. And about 30,000, about half, are owned by mom and pops. And a
Wow.
lot of them have a tremendous amount of meat on the bone, sort of like
Wow.
multifamily might have been 20 years ago. And so, so many opportunities there that I haven't seen in multifamily in a while. I know that's going to come back around, but at the moment, as we record this, like I said, our acquisitions effort failed. Other people have done a great job in that area that we did not.
Well, you're absolutely right. I mean, cap rates are so compressed, and we're seeing there was a deal. It was early in 2019. I was looking at this student housing deal. I forget how many units it was, but basically, I pegged the price that we could pay at around, let's call it. It was right around 3.5 million, I believe, and I was talking to the broker and getting ready to submit a LOI, and he said, "Don't even waste your time. We're about to go under contract with someone at 5 million." I'm like,
Five
how are
million.
they going to make any money on that? It just made no
Wow.
sense to me.
They're just snatching
Yeah.
it up.
And I totally agree with what you're saying about people are overpaying. We're seeing that left and right.
Yeah.
So
Well, I mean that, let's be honest, and I hope it doesn't happen, Will, but that property might be available again
I was thinking the
in the
same thing.
$2.5 million range when things shift here.
That's exactly
Very
right.
true.
Yeah.
So Paul, tell us kind of about your first multifamily deal and how you came to acquire it.
Yeah, so we did the ground up development in North Dakota, and
Yep.
I mean, literally, I don't think it could have gone any better. It went so well. Um, and I could talk about that. I will tell you that we were charging, I think it was 10. So if the national average is about $1 per square foot per month in rent, if you had decided to, look across the heartland of America, a 900 square foot apartment might rent for 900 a month. We were actually charging, I think it was 10 or 11 times that per
Wow.
square foot. We were charging $4,000 a month for a 300 square foot unit. So actually, we were
How?
charging $13 a square foot.
That's
Um,
incredible.
Now, this included, I will say, they were furnished. They included the utilities. And it was basically they have very flexible lease terms. They could get in and out anytime they wanted. But
Uh,
the how was because the oil companies in the North Dakota Bakken oil rush were funding these. And so these guys were sleeping in their trucks, they were sleeping in their cars, they were sleeping at rest stops. And we're talking about 40 degrees below in
Hmm.
North Dakota winter. And so they just needed a place to stay so they could keep these oil rigs running. And so they were more than happy. Now, if you think about $4,000 a month, it sounds horrible when you think about it as an apartment. But if you think about it as a hotel room, that's only $129 a night, which is not bad at all.
right.
It makes a lot more sense when we put it that way, actually. Yeah.
Yeah.
Yeah, that's absolutely right. And the
Yeah.
company's paying for it. So
Right.
yeah, that's good stuff.
So I got to imagine there's some deals that didn't go so well for you in the multifamily. Is there
Yeah.
anything willing to share about any of those?
Absolutely. So I will tell you, we bought a 125 unit multifamily in 2017, and we got in, and so many things went wrong.
Where
But
was it?
it was in Lexington, Kentucky.
Okay.
And I'll tell you that one thing that went wrong. I've never shared this publicly either, but I don't think we really listened as carefully as we should have to our mentors about the age of the property. It was a 1962 property. And, we're talking here about all the overbidding, all the overheated situation. Well, we were finally like, okay, we're just going to go buy an older property than we've been looking at. And we're really going to hope, we found some efficiencies. We found some things that I don't even know if the broker knew about some significant water leaks in their water system. Like their pool was going down 6 inches a day, for example. We asked the maintenance guy, what are you doing about this? He said, oh, we just fill it up again
I
every
was
day.
just about to
And
say
so
We just bring the hose over.
the typical
Yeah.
guy answer. Yeah, just pour more
Yeah,
water.
right.
Right.
Yeah. So we realized, that there could be some very significant savings in this realm, and we did. We were able to accomplish a lot of that. We were able to turn this around. But I will tell you that the tenant base was much, much worse than we had anticipated, even though we did a ton of due diligence. And secondly, the water pipes, the same, leak situation, it turned out that some of them were rotting underground, some of the old cast
Oh
iron
man.
pipes. We had one repair, guys, that was $107,000.
Oh.
And it's possible that same repair might need to be done in most of the 19 buildings. And so if that happened, we're talking a $2 million potential liability. So very, very nerve-wracking situation. That hasn't happened in the other buildings yet.
Oh,
We've
so
had
you still
one
own
that's,
it?
yeah.
Okay.
But it has not had the returns and it just has not gone like we planned.
Have you guys had to have the partners all had to put
No,
have they had to put more money into it?
no, we haven't. We haven't had a
Okay.
capital call. Thankfully we raised 120,000 more than we needed for capital improvements, and we were about 80,000 below budget on top of that.
Oh, nice.
And
Okay.
So it
so
worked
we
out
had
for you.
the things we can control have gone incredibly well. I mean, right after we got there, the economic occupancy, because of the poor tenant base, we got it down as low as 68%, which was not fun.
Wow.
But now the physical occupancy has been trending between 96 and 99.2% for the last 8 months or so. So we're
Great.
super happy with where it's gone.
Yeah, that's great. So what are some lessons, hindsight's 2020. So what are some lessons that you can share with our audience about that one and how to avoid it in the future?
Yeah, I think I would probably spend the extra few $1,000s to camera the lines
Mm.
if I was buying a property like that again, especially if it was older. Number two, well, I wouldn't have had a
Well,
camera because I wouldn't have bought an older property. I wouldn't have bought
Right.
one that old again.
What year was it built?
it was 62.
62.
Oh,
Yeah, so
62.
it's like
Okay, yeah.
57 years old as of last year.
Oh, wow.
Wow.
Okay.
So when you say camera the lines, what do you mean by that?
I would have, taken one of those plumbing cameras and like
Oh,
run
camera
it
that.
through the
Okay.
water
Yeah.
lines
Yep.
to check the condition of the lines.
Yeah.
Um,
And that would have killed the deal right there, and you would have
yeah.
you would have saved a lot of money.
Yeah, it turns out that the deal before that we were under contract on was larger than that one. And we actually killed that deal for a somewhat similar reason. We found black mold in about half of the basements in this
Mm.
Oh
property,
wow.
and it was untreated. And we actually got a tip from the maintenance guy that the owners knew about it and were trying to either ignore it or cover it up.
Oh man.
Very
Well, that's
interesting.
good that they shared that with you.
Yeah, it was great.
Yeah, can you talk about now a happy deal, the one that went really really well, not maybe excluding the one where you built from ground up. Can you talk about one that went really well and you guys really executed the business plan tremendously?
Yeah, well, it's actually, so the situation is we have changed our business model. We looked at our team, like I said, we failed at acquiring, and we didn't have a lot of people on our team. We had 4 people on the team that had a lot of on the ground construction and operations experience. And so because of that, we changed our model about a year and a half ago to actually partner with great operators. We're vetting operators, we're bringing equity, and we're investing in their deals. And so
Oh, nice.
we recently invested in a portfolio um, of mobile home parks, self storage. But one of the recent deals was actually in a city I was very familiar with, Minot, North Dakota. They actually bought 2 mobile home parks, and the owner, I don't want to say they were free at all, but they threw in 3 multifamily buildings. I think they were 16 units each.
Buy a mobile home
So
park, get a multifamily for free. Is
yeah,
Yeah.
that kind of
right. Yeah, yeah,
yeah?
yeah. So I wouldn't say it was for free, but
No,
they
I'm
did
kidding.
throw those in, and so those that portfolio is going surprisingly well. And it part of the reason is the reason I mentioned earlier is when you buy from a mom and pop owner, you get all kinds of potential upgrade opportunities that it's really hard to find elsewhere. So we've been super over the top happy with the performance of our fund over the last little over a year.
So it's mainly just been coming in and upgrading the management where the mom and pop were probably not managing it the way that they could
Yeah,
have. You know, maybe there's some deferred maintenance and stuff like that.
yeah,
You guys came in and I assume you have a third party professional management company and that's solved a lot of the problems and you've been able to capitalize on it. Is that right?
yeah, yeah. And if I can have a minute, I can give you a quick example of how much
Please,
fun this has been.
please
This
do.
will kind of demonstrate the power of the commercial value formula. Now I'm going to fly here. So round numbers. Imagine paying 5 million for a park, mobile home park now, but it would go for multifamily too or self storage.
Yep.
5 million, 3 million in debt, 2 million in equity. Okay. Now the asset manager goes to this mobile home park and he goes, "Hey, there's a second or third or fourth or fifth car parked all around these trailers, mobile homes. There's boats and work trailers and RVs." And so what he did is he paved an acre toward the front. He put a nice fence around it with a gate. And he said, "Okay, if you've got an extra vehicle like that, you've got to park it in here and we're going to charge you." Now, he spent $100,000 paving and gating this 1 acre. Now, when it's fully leased up, guys, it'll lease for $10,000 total per month. Now, let's do the math, the value formula. 10,000 a month is $120,000 a year.
Yep.
That's the increase in net operating income because there's no real cost to it after except for the capital. And so then the cap rate, let's just go with a median number of 6%. So you divide $120,000 a year by 0.06, that's 2 million in additional value that's been created. Now remember the math, there was 3 million in
In debt.
debt,
Yep.
2 million in equity. He just doubled the value of the equity, at least once it's leased up for a while. He doubled the
It's
value of the
amazing.
equity by this one change. And like you were talking about earlier, when you add $50 a month to rent or whatever, it is a huge increase in value to the equity shareholders. And hence, this is why, again, I and you both love commercial, multifamily, self-storage, and mobile home parks. We love the opportunity to get these kind of benefits, and the tax benefits on top of that are stunning.
Can you touch on that's an amazing story.
Yeah,
Putting
I
in
mean,
100,000 to create over $2 million
Yeah.
is an unbelievable return, obviously. Um,
it's
so that
something that simple too, just putting in a
right.
parking lot. I mean,
Yeah.
that's a great example.
Yeah. Can you speaking on the tax benefits, can you touch on
Yeah.
that for a second and just share how that works?
Yeah, there are about 12 or 13 different tax benefits to commercial real estate investing, tax strategies, I should say. And one obvious one is the cost segregation study. You know, if you've got a commercial building or even a duplex that's worth 200,000 or so or more, and they were up to a very expensive building, you can do a cost segregation study which breaks out the components into real estate versus personal property, and the personal property things like carpet, lighting, electrical, roofs, landscaping, all kinds of things like that, countertops, refrigerators, flooring, paint, all those things can be depreciated much more quickly than the building itself. And by doing this, you create a paper loss on your tax return, the K1, for investors for the first, let's just say, 4, 5, 6, 7 years perhaps. And so by creating that paper loss, it's an incredible way of building wealth, especially when you can refinance the equity back to the investor. They can go take that money tax free, reinvest it somewhere else, and there's no taxes in those early years. And then, of course, there's other things that can be done later, including a 1031 exchange and the other things like that to kick the can down the road or even avoid the tax altogether.
Yeah, and what's amazing to me is that the property should, if managed correctly, it should make money for a limited partner throughout the year, and then come tax time, they get a negative K1, so it shows on paper that they lost money. So they can then take that loss and either, if they're a real estate professional, they can apply it towards earned ordinary income, or if they're not, then it just carries forward to a capital gain down the road.
Right.
And that to me is just, it's not really, when you're looking at pro formas and all that, it's not all, it doesn't show that on there. But if you understand all of that, it just makes it that much better and that much more
Yeah.
appealing.
Right.
So
I
that's
totally agree.
that's
It's
great.
amazing.
So Paul, what do you have in store for you in the future coming up?
So, once another part of my journey, which we don't have time to touch on much, would be learning the difference between speculating and investing, which I'll touch on in our very final segment. But um, we realized that our very best path forward at Wellings Capital would be to find best in class operators that have a tremendous track record, usually since before the Great Recession, and then invest heavily with them. And so I've narrowed my focus down to, from all these other things, down to mainly just finding great operators and raising capital to invest heavily with them. And so I do that by creating content like podcasts, books, etc., which I love to do. And so I'm narrowing my focus more and more as I get older, and I'm enjoying this even more than ever.
That's
That's
great.
great. And I
Yeah,
want
I
to
can just
touch,
hear that you're passionate and loving what you do.
yeah, I want to touch on the book real quick. I know
Yeah.
Will's read it. I know my dad's read it, and he recommended it to me, and it just haven't gotten to it yet.
So
But
you're the only one that hasn't read it.
I'm the only one that has not read it. I'll
What
admit
what
that, but I
Paul, you
will
need to
be reading
smack
it.
him.
Yeah, I will be
Okay.
reading it. I promise you that. But it's called The Perfect Investment. So talk to us real quick about what gave you the idea and the inspiration to kind of write this book.
Yeah. So after going through the mentoring program, we were spinning our wheels trying to acquire multifamily. And like I said, I learned so much in the mentoring program, and I couldn't find a book that exactly explained it in a simple way to people. And so I started writing special reports and, to eventually go on the website. And I realized, man, I got all these special reports, all this content. I wrote a book before years ago, and I realized that, once you convert it to book page size, you take 60 pages of content and turn it into a 180-page book. And so I just realized I might as well just go the extra mile and just make it into a book. And I had to get my mentor's approval because I had learned so much from him that's in the book. But yeah, it was fun, and I'm so glad I did it.
Oh yeah, so am I, because it's one of the early things that I started. I started listening to Michael Blanc and Corey Peterson's podcast, and then
Yeah,
I think that's how I got turned on to your book. But yeah, then I read your book, and it was just instrumental. So
awesome.
I'm glad that you wrote
Yeah, I've
it.
heard excellent things about it. So I apologize to you now that I haven't read it, but I promise I will be reading it. So,
Yep.
Awesome.
Yeah.
well, Paul, we're going to jump into our Moments of Truth segment. It's the same 7 questions that we ask all of our guests. Now I'm just going to get started with the first one. Who is your success role model?
I would say Warren Buffett, because Warren Buffett he doesn't make ice cream. He doesn't create insurance policies. He doesn't build mobile homes, but he partners with operators, partners with experts in all these fields. He only has like 28 people in his office, one of the largest companies in America, and he
So,
partners successfully with them. So, and for many reasons, he's definitely the guy.
Yeah, he's
that,
he's
that
he's fascinating.
I didn't know that about him, but that's very interesting.
Yeah,
Yeah.
Berkshire. They just buy stuff and let it be run by whoever's running it, basically.
Right. Let the
So
experts do it.
yeah,
Yeah.
no, he's good. What's your biggest success?
I would say, professionally, it would definitely be the multifamily thing we did in North Dakota up until this last year when we created the Wellings Income Fund. And it's just, again, it's just in its first like 13 months right now, but it appears from what we've seen so far it's just going to be, I mean, we're very, very happy with the results we've seen so far. I think it will easily be the biggest success at the end of the day.
That's great.
Yeah. What's a typical day for you look like?
Yeah, so get up about 6 o'clock, exercise for half an hour, listen to either an audio book or some kind of sermon or something like that. Then I actually spend some time with coffee, meditating, reading, journaling. I'm actually writing like a devotional book now based on all kinds of wonders of the universe, and it's really fun. So
Oh,
I
that's cool.
spend time in that period. And then like about 2 hours and 15 minutes into the day, I finally start work. I try to spend the first half of the day just devoted to projects, and then the last half of the day on either doing podcasts or investor phone calls and emails.
Nice.
It's a great day.
Yep. What is your favorite quote?
I'm really, really in a lot of pain still from my chasing shiny objects and speculating like I used to do. So I love the quote by Paul Samuelson. He's the first economist, U.S. economist, to get the Nobel Peace Prize. And he said, investing should be more like watching grass grow or watching paint dry. If you want excitement, take $800 and go to Las Vegas.
That very,
That
very true. I
that is
like
so
that
good.
because it takes time to build your wealth. It takes time for all this stuff to happen. None of it's going to happen overnight.
Yeah.
And
Yeah, back to Warren Buffett. He talks about compound interest over
Yeah.
time, and he was very. If you look back, he started a long time ago, and he was very slow. He was not an overnight success by any means. So that's such a true. I love that quote. It's good.
Yeah, he told Mark Zuckerberg, he said, the reason people won't imitate me is, he said, who would want to get wealthy this slow?
Yeah, that's right. People want to
Hilarious.
do the quick. The
yeah,
Bill Gates and the Mark Zuckerberg, and they've
Yeah,
done awesome stuff, but it's just totally different from what Warren Buffett has done.
right.
Yeah.
so next question here. What are some of your hobbies?
I actually told somebody on a podcast once that I love work so much. Work and writing is my hobby, but that's a lame answer. So, yeah, actually, no, I really love spending time with my family. My son and I, for example, go on fishing trips to Ontario, Canada quite often. I got 3 daughters. I love spending time with them as well. And I play guitar, electric guitar and bass for fun as well.
Nice.
You were telling us prior to the interview, you guys used to have a little band that would play on the weekends, right?
Yeah, yeah. I was in a band with Whitney Sewell from the real estate
Yeah,
syndication show. I mean, we played, not that often, but it was a lot of fun when we did.
that's
Yeah,
good
that's
stuff.
awesome.
What's the best business book that you've read and you can't say your own?
I won't.
I'm
Um,
kidding.
my favorite is from the world's foremost real estate broker, Gary Keller and Jay Papasan. It's called The One Thing,
Mm,
and it's really, really taught me about the importance on a hour by hour and over the course of your lifetime, the importance of saying no to distractions and focusing on what's most important.
yeah, that's so true. The
Paul,
whole you chase two rabbits, you end up catching
Yeah,
neither of them.
right.
Yeah.
well, Paul, I have read that book, but yes, I agree with you on that one.
Yeah.
So, the last question here: if there's one key piece of advice you could leave our listeners with about achieving success, what do you think it would be?
I would go back to the same thing I mentioned earlier, and that is I would understand the difference between speculating and investing. Investing is when your principal is generally safe and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. And I did not understand those two for many, many years. And so I lost a lot of money. I made some money along the way as well. But man, once I discovered, cash flowing commercial real estate, I realized that was a true investment, and that's where I'm hanging my hat.
Yeah. It's a game changer.
That was kind of going to be one of my questions real quick was at what point did you realize the difference that you were speculating and investing? But I think you kind of answered it with, once you realized the cash flowing real estate assets was the difference.
Yeah, I mean, I was actually listening to a podcast with Bill Manacero called the Old Dogs Realty podcast, and he was talking about um, Buffett before I got into Buffett. This was probably 3 or 4 years ago, and that's when I realized that the aha moment really hit me. Then that something that has a cash flow has a value. True wealth
Right.
is assets that produce income. And not knocking it. I mean, I have a friend who made a ton of money in Bitcoin, but it was speculative because there was
Right.
no true value. You couldn't peg it to an income stream, and therefore it was 100% based on emotions and all these things. And sure, go ahead and do that, but you're taking your chances.
Yeah. It's like going to Vegas and putting what is it, playing roulette and putting everything on
Yeah.
one
One
number.
color. Yep.
Right.
Yeah.
Right. So yeah, it's so true.
So Paul, how can our listeners get in contact with you and the names of your books? I know you got one coming out soon, or you're working on one, and
Yeah.
all that.
I've got, The Perfect Investments on Amazon. My new book is going to be something like the book on commercial self-storage or the book on self-storage. It's going to be published by Bigger Pockets Publishing.
Oh,
And
nice.
but people can get hold of me at wellingscapital.com. That's WELLINGSCAPITAL, wellingscapital.com.
That's great. And Paul, we will have a link to your book in our show notes, so that way, if anybody listening to this, they need to go out and grab it. And while I'm creating the show notes, I will make sure I get a copy of the book as well.
Yeah.
So
And
that
when
next
when
time,
is the when this is for my own selfish interest, when is the self-storage book coming out?
It's due to come out approximately May of
Okay.
2020, in about
Okay.
4 or 5 more months.
I see.
awesome.
Very cool.
Well, Paul, we appreciate you being on the show today. I had a great time talking with you, and I know Will is happy to be able to speak to somebody that's
Yeah.
made an impact on his life. So we appreciate you being on the show today.
All right. Thank you so much. It was great being here, guys. A real honor.
Thank you, and we'll
Thanks,
see
Paul.
everybody tomorrow.